Okay, this is Finance 3850, Chapter 8. We're going to be talking today about common stock valuation. So let's start off with a little question. So imagine that you own a company. The question is, what do you actually own? Well, you own some assets, and you can use those assets to produce a product or a service that you will then sell. From the revenue that you earn, you will pay some expenses, and eventually you'll have some net income. So those assets are the core of the company. And in fact, the value of the company is equal to the value of the assets. And so the first question that we need to answer is, how much are those assets worth? Well, we've talked before, I think, about the value of anything being the present value of the expected future cash flows. And that's true for the assets of the firm as well. So let's think about a balance sheet, and specifically what I call the balance sheet equation. And the balance sheet equation says that the total assets must equal the sum of the total liabilities and the total equity. That has to be true. All that really says is that the balance sheet must balance. Now, the problem with that balance sheet identity or equation that we just talked about is that the value of the assets as well as the liabilities and the equity is in what we call book value terms. In other words, that's the historical value of the assets. What we really care about is what is the market value of the assets. In other words, if we were to sell them right now, how much money could we get for them? And that is almost certainly different from what they're kept on the balance sheet at. So we want to take that balance sheet identity and convert it into market values. And that's what we see here. In the equation, the V stands for value. So we have the value of the assets equals the value of the debt and the value of the equity. And of course, when I say value here, I'm talking about the market value. So the market value of the assets equals the market value of the debt plus the market value of the equity. Now, one important thing to be aware of is that we, generally speaking, don't care very much about the value of the debt. And the reason is very simple. If you're going to buy a company, you're going to pay for the equity and assume the debt. In other words, you're going to take over the debt payments. So you don't need to come up with the cash to pay off all of the debt. All you need is the cash to purchase the equity. Now, the value of the firm is the value of the assets, and the value of the assets is the present value of the cash flows that they're going to produce. And more specifically, the value of the assets or the operations of the firm is the present value of all of the future free cash flows that we expect to receive, discounted at the weighted average cost of capital. Now, we can break up the value of the firm actually into two components. We have the operations, that is the day-to-day things that a company does. And then most companies will also have some non-operating assets. These are things like short-term investments, for example. And so the total value of the firm is the value of the operations plus the value of the non-operating assets. And that's what the second equation here shows. Now, we're not going to concern ourselves too much with the value of the non-operating assets. Technically speaking, the value of the non-operating assets is the present value of their expected future cash flows. However, the non-operating assets generally are going to be marked to market every quarter. In other words, the current value of those assets will be written into the balance sheet every quarter. And so it's good enough for us to simply take the value of the non-operating assets right off of the balance sheet. And generally, again, what that means is you're going to go to the short-term investments, and whatever that value is, that's what you would plug into this equation for the value of the non-operating assets. Now, an important point to note is that the discount rate that we use when we're discounting the expected future free cash flows is the weighted average cost of capital. The reason that we use the weighted average cost of capital is because we're discounting free cash flows. And remember who has a claim on the free cash flows of the firm. It's the investors of the firm. And by investors, I mean all of the investors. So I'm talking about the creditors, preferred stockholders, and common stockholders. So if you remember back to Chapter 6, we talked about the possible uses of free cash flow. So you can pay interest. That goes to the creditors. You could pay principal on any loans. That goes to the creditors. You could pay dividends. That goes to stockholders. You can buy back stock. That goes to stockholders. And if you still have some of the free cash flow left over, the only thing left to do with it is to invest in non-operating assets. So since both the creditors and the shareholders have a claim on the free cash flows, we need to use a discount rate that combines the required return of the creditors with the required return of the shareholders. And that rate of return is called the weighted average cost of capital. We'll talk about that some more in Chapter 11. For our purposes now, we'll simply take that as a given. So we've seen that the value of the firm is equal to the value of the assets, which in turn is the present value of the expected future free cash flows. But also, the value of the firm, as we saw originally, is the value of the debt plus the value of the preferred stock plus the value of the common stock. And I said earlier that what we care about is the value of the common equity or the common stock. And so from this first equation here, you can see that if we know the value of the firm, and we can calculate that, again, that's the present value of the expected future free cash flows plus the value of the non-operating assets. So if we know that, we can solve this equation for the value of the common stock. And more specifically, the value of the common stock is the value of the firm as a whole minus the value of the debt minus the value of the preferred stock. This is what we care about as an investor in the company, or if you run a company and you're seeking to acquire another one. Now, we have a little problem here. Looking at our value of operations formula again, same one we've seen, notice that we are calculating the present value of the free cash flows from period 1 all the way out to period infinity. Now clearly, we cannot add up an infinite number of free cash flows or present values of free cash flows. So we need to have some way to solve for the present value without having to add up an infinite number of present values. So we have basically two choices. There's more than that, as we'll see here in a little bit, but basically we have two choices. The first is to assume that the free cash flows are going to grow at a constant rate forever. Now, as we'll see, what that means is that if you know today's free cash flow, you know every free cash flow from now till infinity. And it turns out that we can actually calculate that pretty simply. The second, and much more common way of handling this, is to forecast the next several free cash flows individually. Typically, it would be the next 5 years worth of free cash flows. So we're gonna generate a forecast for each of those, and then after that, we will assume that the free cash flows are going to grow at a constant rate forever. So the idea here is that we might have a pretty good idea of what free cash flows are going to look like for the next 5 years, but beyond that, we don't have much of an idea. A lot of things change after 5 years in the future. And so we might be very uncertain about that. And so maybe the best that we can do is to assume that free cash flows will grow at a constant rate forever after that. Now, you've seen in probably several other classes this idea of valuing a share of stock based on the present value of all the future dividends. And more specifically, you've said, well, what if those dividends grow at a constant rate forever? Well, then we have a very simple equation. This is known as the constant growth dividend discount model, or just a DDM. And this model says that the value of a share of common stock is today's dividend, D sub 0, times 1 plus G, G is the growth rate, divided by K minus G. And K in this case, or K sub CS, is the required return on the common stock. So here I'm using K instead of R or I or some other letter. Okay, it doesn't matter what it is. K is a very common one to use for what we're doing now. And then also note that D0 times 1 plus G is just the next period's dividend, or in other words, D1. So we could just say D1 divided by K minus G. Now, what you might not have realized in the past, and I hope you understand now, is that this is not just a present value of dividends formula. This is actually a formula for finding the present value of any kind of cash flow that grows at a constant rate forever. And so remember our problem here. What we want to do is find the present value of a series of free cash flows that are going to grow at a constant rate forever. So really, all we need to do is substitute free cash flow for dividends in that formula. And you can see the result at the bottom of the slide here. Exactly the same formula, but now we're using free cash flows, and of course the present value of the future free cash flows gives us the value of the operations of the firm. So let's look at an example. So you're evaluating the purchase of a company that's recently generated free cash flow of $1,500. Okay. Now, notice it said recently generated. That means that this is free cash flow 0. Your firm expects the free cash flow to grow at a rate of 3% per year forever. Further, the target firm has short-term investments worth $2,000. So if your firm's cost of capital is 9%, what is the value of the target firm's operations and the value of the entire firm? Well, you can see in the equation, free cash flow 0 is $1,500, so we take $1,500 times 1 plus G, and G is 3%, divided by the cost of capital minus the growth rate. Cost of capital is 9%, growth rate is 3. So when we do that, we find that the value of operations is $25,750. Now, recall that the value of the firm is the value of the operations plus the value of any non-operating assets, and we said that they have non-operating assets of $2,000. Therefore, the value of the firm as a whole is $27,750. Okay, great. Now, what we really want to know is what is the value of the common stock, because remember, you're going to buy this company, or you're thinking about buying this company, and so you need to know what is the highest price that I would be willing to pay to acquire the common stock in this firm. So to find that, we're going to take the value of the firm, $27,750, minus the value of the debt, minus the value of the preferred equity, and the problem tells us that the firm has $7,000 in debt, $3,000 in preferred equity. So $27,750 minus $7,000 minus $3,000 is $17,750. Now, if you're going to make a bid for this company and it's a publicly traded firm, generally you would phrase that bid in terms of a price per share. So we know that the common equity is worth $17,750. If we divide that by the number of shares outstanding, which is 5,000, we get a price of $3.55 per share. So that's a pretty simple example, but you can see how we do it. First, we find the value of operations. Then we add the value of any non-operating assets to get the value of the firm. From that, we subtract the value of any debt and the value of any preferred equity. That gives us the value of the common equity. Divide that by the number of shares, and we get a value per share. Okay, so let's make this a little bit more complicated. In this case, we have the same target company, but we've just learned that they launched a new product, and we expect that that product will increase the growth of their free cash flows for the next 5 years. And specifically, our forecasts tell us that we now expect that they will generate $1,700 in free cash flow in year 1, $2,000 in year 2, $2,200 in year 3, $2,400 in year 4, and $2,500 in year 5. After that, we're going to assume that the firm is going to grow at a constant rate of 3% per year forever. So you can see here that we have non-constant growth. I mean, clearly the growth rate from 1,700 to 2,000 is more than the growth rate from 2,000 to 2,200. So the growth rate now is not constant during the first 5 years. So how do we handle this? Well, remember, same basic idea. The value of the firm, or the value of the firm's operations, I should say, is the present value of all the future free cash flows. So the first thing that we have to do is to find the free cash flow in period 6, and then we're going to use that to find the value of the firm's operations as of year 5. Let's go back to our equation here. Notice the value of operations is free cash flow 1 divided by the cost of capital minus the growth rate. Well, that'll give us the value of operations at period 0. Okay. In this case, we have constant growth beginning at the end of year 5. So free cash flow 1 in this case is really free cash flow 6. And if we plug that into this equation, that's going to give us the value of operations at period 5. Now, that value of free cash flows at period 5 is what we call the horizon value of the firm. The reason that we call it the horizon value is because that's the value at some future point in time. In other words, out there on the horizon, the value of the firm would be whatever, and we're about to see what that would be. So we're going to use a principle here, and this is known as the principle of value additivity, and that is we can take any series of cash flows and find the total value of all of those cash flows by valuing them in pieces. So when we add up the present values of all the pieces, we get the present value of the cash flows as a whole. And so in this case, we're going to find the present value of the first 5 free cash flows. And then we're going to find the present value as of today of all the free cash flows from period 6 on out to infinity. And so let's do this piece by piece. So the present value of the first 5 free cash flows, you can see, we're going to take each of them divided by 1 plus the cost of capital to whatever power. So 1700 divided by 1.09 plus 2000 divided by 1.09 squared, and so on. That gives us 8,266.85. Now, when we plug in the free cash flow from period 6, 2575, into our constant growth model, that gives us a value of 42,916.67. But you have to remember, that is not as of period 0. That is as of period 5. And so we're going to need to discount that from period 5 back to period 0. So the 42,916.67, that's our horizon value. And so when we discount that back to period 0 and add that to the present value of the first 5 free cash flows, we get a value of operations of 36,159.74. Now, what I have on this slide is a little animated GIF file that I've created that kind of shows the steps here. So first we find the horizon value. Then we find the present value of all of those free cash flows and the horizon value, add them together, and we get 36,159.73. If you want to do this on your financial calculator, the easiest way to do this is by using the NPV function. And you can see that at the bottom of the screen here. So we put in NPV, 9% discount rate, 0 for the initial outlay, then a list of the cash flows, and you can see the result that we get. Now, we found that the value of operations was 36,159.74. So the value of the firm is that number plus the 2,000 that they have in non-operating assets. So we get a total value of the firm of 38,159.74. Now, remember, we want the value of the common equity. So from that 38,159.74, we're going to subtract the value of the debt and the value of the preferred. That gives us 28,159.74. Now recall that the company has 5,000 shares of common stock outstanding, so 28,159.74 divided by 5,000 gives us a value per share of 563. Now, when we assumed that the company was a constant growth firm, we got a value of 355. But now we're assuming that they're going to grow a little more quickly for the next 5 years. And that additional growth has added to the value of the stock. And specifically, we found that the value of the stock was 563, which means that the value of the new product line is $2.08 per common share. That's almost a 60% increase. Okay, so let's take a look at how you can do this on your financial calculator. So I mentioned earlier using the NPV function. And here you can see the timeline that we have. We have our first 5 free cash flows, and we've already calculated the horizon value of 42,916.67. So what you're going to do is you're going to press the apps button on your calculator, choose finance, and then I believe it's number 7 is the NPV function. And when you do that, it'll pop up NPV on the screen, and then you'll enter your cost of capital, 9%, comma, 0 for the initial outlay. We'll talk about that in just a second, comma, and then a list of the cash flows. And notice that the list of the cash flows is in curly braces. So we can do this in memory rather than creating a list in the calculator. It's just a little bit easier. And when we do that, we get 36,159.74, which is precisely the same answer that we got earlier. We could do just exactly what we did before. Add the $2,000 in non-operating assets. That would give us 38,159.74. Subtract the value of the debt and the value of the preferred stock, and then divide by the number of shares, and we would get our stock price. Now, let's talk about that little trick that we used inside the NPV function there. So the key point to remember, and we'll talk about this in chapter 12, but the key point to remember is that net present value, or NPV, is defined as present value of the cash flows minus the cost of the investment, which I've labeled here as IO. In other words, initial outlay. What we're doing is we're telling the calculator, we're lying to the calculator and telling it that the initial outlay is 0. And when we do that, you can see NPV is equal to the present value of the cash flows minus 0, or in other words, NPV will give us the present value of the cash flows. And that is what we want in this case. So let's go back, and you can see here that 0 is what we put in for the initial outlay, the second argument in that NPV function. And so the 36,159.74, that's the present value, not the net present value, but just the present value of those cash flows. This is a very useful trick that you really should remember. Okay, so we've looked at two ways of valuing the firm. First, we said, well, what if it's a constant growth firm? And we used that constant growth dividend discount model with free cash flows to find that. And then we did what I call the generalized non-constant growth model. Now, I just want to mention that there are other assumptions that we could make. So no matter what assumption we make, the value of the stock is still the present value of the expected future free cash flows plus the value of the non-operating assets. That doesn't change. But when we're finding the present value of the future free cash flows, there's a lot of different assumptions that we can make regarding the future growth of those cash flows. And when we do that, there are different formulas that we can use. So for example, there's a two-stage model. This assumes that the stock is growing at some, usually a high rate now, that it cannot sustain forever. And eventually, it will drop down to some long-run sustainable growth rate. So there's two phases or two stages of growth. And so there's a formula to handle that. And we're not concerned about what that formula is. I just want you to be aware that it exists. We can also do a three-stage model. Same basic idea. There's three different phases of growth, and we can derive a formula to find the present value of those cash flows under those conditions. Really, there's no reason why we couldn't use 4 stages of growth or 5 or 6. It just, at some point, it gets more complicated than it's worth. And so generally, we're going to use either constant growth, the generalized non-constant growth model, or maybe a 2-stage or a 3-stage model. But by far, the most common is that generalized non-constant growth model. That's the one that the professional analysts typically use. All right, so let's wrap this up. So we've seen that the value of the firm is the value of its operating assets plus the value of its non-operating assets. So that means we're going to find the present value of the expected future free cash flows. That gives us the value of operations. And then to that, we're going to add the value of non-operating assets. And typically we read those right off of the balance sheet. So now we're going to take a quick look at the mini case. Okay, so now we're going to take a look at the mini case from chapter 8. And in this mini case, what we have is that you work for a firm that is considering expansion into some related fields and a possible acquisition of a company called TempForce. Now, your employer is also considering purchasing Biggerstaff and McDonald, and this company currently has free cash flow of $24 million. So you notice I have right up here $24 million, which is expected to grow at a constant rate of 5% per year. So I've got my constant growth rate. And the financial statements report short-term investments. Now remember, this is the non-operating assets of the firm. And so we're going to take that right off of the balance sheet. They have debt of $200 million and preferred stock of $50 million. And the weighted average cost of capital is 11%. So I have all of my data here at the beginning of my spreadsheet. Now, let me remind you that this is not a spreadsheet class. If you're interested in that, I do teach finance 4200, which will tell you or teach you how to create spreadsheets to do this kind of thing. But that's not the purpose here. The reason that I supply these spreadsheets is simply because it's a convenient format to lay out the solutions. And all you really need to do is be able to open them and look at them to see the quantitative answers. Now, I'm not going to go through every question in the mini case here. I'm going to focus on the quantitative questions. However, let me remind you that the exams in this class are both quantitative and qualitative. In other words, you need to understand the concepts every bit as much, if not more, than doing the calculations. And so that's very important. Okay, but I think going through the calculations here will help you to understand the concepts. So let's start off with question E, and it says, use B&M's data and the free cash flow valuation model to answer the following questions. Now, remember that Biggerstaff and McDonald is a constant growth firm, right? They're growing at 5% per year, and we know that their initial period zero free cash flow is $24 million. So the question is, what is the value of operations? So to find out, we're going to take our 24 million times 1.05. That gives us free cash flow in the next period. And then we're going to divide by the weighted average cost of capital minus the growth rate. So divide by 11% minus 5%. That gives us 420 million as the value of the firm, or the value of operation. Now, the total value of the firm, remember, is going to be the value of operations plus the value of the non-operating assets. So 420 million plus 100 million is 520 million. The value of the equity is going to be the value of the firm minus the value of the debt minus the value of the preferred stock. 520 million minus 200 million minus 50 million gives us 270 million. Now, question 3 says, what is its estimated intrinsic value? Well, the intrinsic value is the 270 million. That's the value of the equity. The next question says, what is the value per share? And in this case, they said in the very beginning that this company is owned by two friends and they each own 5 million shares. So that's 10 million shares total. So 270 million divided by 10 million is $27 per share. Now, the next question says that you've just learned that B&M has undertaken a major expansion that will change its expected free cash flows to negative 10 million, 20 million, and 35 million over the next 3 years. And then after that, free cash flow will continue to grow at a rate of 5% per year forever. We're still using the same cost of capital, same number of shares, and they ask, what is the company's horizon value? Now remember, the horizon value is what is the company going to be worth at some future point in time? And that future point in time is virtually always at the end of the non-constant growth phase. So in this case, we have 3 years of non-constant growth. So we're going to find the value of the firm at the end of year 3. And remember, the value of operations at that time, or in other words, the horizon value, is going to be the present value of all of the free cash flows from year 4, 5, 6, on out to infinity. And again, we're assuming that at that point, they're going to grow at a constant rate of 5% per year. So the value of the stock then is going to be 35 times 1.05 divided by 11% minus 5% gives us 612.5. Now, the value of operations is going to be the present value of the first 3 free cash flows plus the present value of the horizon value. So when we do that calculation, we get 480.67. And you can see the equation on the screen that shows how to do that. Note that you can also use the NPV function in your calculator exactly in the way that I showed in the lecture prior to us going over the mini case here. Finally, we want to know what is the value of the stock. Well, remember, in order to find the value of the stock, we need to first find the value of the firm. Okay, and the value of the firm is the value of operations plus the short-term investments, so that'll be 580.67, and then minus the value of the debt and the value of the firm, of the preferred. So that gives us 330.67 is the value of the firm, the value of the equity at period 0. And then the value of the stock per share is the 330.67 divided by 10, or 33.07 per share. Now, question G asks, if B&M undertakes the expansion, what percentage of the value of operations at year 0, remember that was 480.67, is due to the cash flows from years 4 and beyond? So remember that we found the horizon value of the stock. That's the present value of all of the free cash flows from year 4 out to infinity. So when we find the present value of that, okay, by discounting it at 11% for 3 years, we get 447.85. And then that divided by 480.67, which is the value of operations at period 0, tells us that 93% of the value of operations is due to those cash flows from year 4 and beyond. This is important because what that tells us is that most of the value of the firm comes from those cash flows out in the future, not so much the very near-term cash flows. And so that indicates that management should focus on long-term value creation, not just on the next quarter's earnings or the next couple of years worth of earnings, but they should be making decisions for the long run, not the short run. Okay, now in part I, they tell us that your employer is considering the purchase of Hatfield Medical Supplies. And they give us a whole bunch of information. For example, sales starts out in year 0 at $2,000. Total operating capital is $1,120. The operating profit margin is 4.5%. Capital requirements ratio is 56%, and the cost of capital is 9%. They also give us growth rates. So they tell us that sales and pretty much everything else is going to grow at 10%, and then 8%, and then 5%, 5%, and 5% forever. Now, in part J, they're asking us to calculate the value of Hatfield Medical Supplies. So in order to do that, of course, just like we've done before, we need to know the future free cash flows. And so by forecasting sales and NOPAT and total operating capital for the next 4 years, we can arrive at forecasts for free cash flow. And you can see what we get. I'm not going to go through how to get these forecasts. Very simple. You're just going to grow each of those variables by the appropriate growth rate. But remember that free cash flow is NOPAT minus the change in total operating capital. So in year 1, that gives us negative 13. In year 2, we get 836. In year 3, we get 4574. And in year 4, we get 4802. Now, the first question in part J is, what is the horizon value? And so remember that the horizon value is simply the value of the firm or the firm's operations as of the end of the non-constant growth period. Now, in this particular case, we could do this prior to year 4, but in year 4, that's the last data that we have, and so we're going to take year 4 as the period of the horizon value. So to get the horizon value, we're going to take the free cash flow in year 4, 4802, times 1 plus the growth rate, which is 5%, divided by the cost of capital, 9%, minus the growth rate, 5%. And when we do that, we get 1,260.65. Now, the next question is, what is the value of operations at year 0? So again, we've done this previously. What we want is the present value of the free cash flows in year 1 through 4 plus the present value of the horizon value that we just calculated. And so you can see the equation for doing that. And when we calculate that, we get 957.53. Now, one of the questions at the end of part J is, how does this year 0 value of operations compare with the year 0 total net operating capital? Well, we get 957.53, but total net operating capital in year 0 was 1120. Now, remember that we said that the value of the firm should be equal to the value of the assets. So you would expect that the value of operations, in this case, notice that they don't have any non-operating assets, so we don't need to worry about that. But you would expect that those two values would be the same. Okay, or at the very least, that the value of operations would be greater than the value of the total operating capital. But that's not the case. And the question is why? And the answer is, if you notice, we've calculated the return on invested capital for each of these years. And you notice that it doesn't change from one year to the next. And the reason that it doesn't change is because everything is growing at the same rate as sales. And so remember, return on invested capital is NOPAT divided by total operating capital. And since NOPAT and total operating capital are growing at the same rate, then our return on invested capital will not change. The key is to notice that the return on invested capital is below the weighted average cost of capital. And what that tells us is that Hatfield Medical Supplies is currently destroying value. And the result of that is that the value of operations is less than the value of their total operating capital. Now, in part K, they ask, what happens if expected growth increases by 1% relative to the original growth rate? So what we're going to do is we're going to change each of our growth rates by 1%. So let me do that. And you notice when we do exactly the same calculations that we did before, the value of operations actually goes down. Now, that seems strange to a lot of people. If the company is growing more quickly than they were previously, you would expect that the value of operations would increase, not decrease. But remember, Hatfield Medical Supplies is destroying value. So when they grow more quickly, they're simply destroying value more quickly. So they're digging that same hole, but they're digging it even faster now. And that's why the value of operations declined. Now, in part L, they say reset the growth rates. So I'll do that. And then it asks what happens to the ROIC and the current value of operations if the operating profitability ratio increases to 5.5%. Well, this is going to be better, obviously, and let's go ahead and change that. And I'm not going to walk you through all of the original calculations again. But when you do that, you can see that the return on invested capital goes from 8.04% to 9.82%. And now, because they're more profitable on an operating basis, they are actually creating value. Remember, the cost of capital is 9%, and now the return on invested capital is exceeding that. So the value of operations then goes to 1522.67 in this scenario. That's considerably higher than what we had before. Now, they also ask you to run through several scenarios. I'm going to skip that. You can play around with this spreadsheet if you want to see that. Basically, we're going to be changing the operating profitability and operating capital. And if we decrease the operating capital to 51%, then you can see that they become even more profitable because they're using less capital. Makes perfect sense. Okay, the last little bit of this mini case that I want to go over starts at part O with the potential acquisition of TempForce. And they tell us that TempForce has a beta coefficient of 1.2. The risk-free rate is 7%, and the market risk premium is 5%. So they want to know what is the required return for TempForce. And to find this, given the information that we have, and remember, anytime you see beta, risk-free rate, expected market return, or market risk premium, you should be thinking CAPM immediately. And that's exactly what we're going to do here. So the CAPM tells us that the required return is 7% plus 1.2 times 5%. Now notice that they've given us the market risk premium. If they had told us that the expected market return was 12%, then we would do, in parentheses, 12 minus 7 gives us the 5% market risk premium times 1.2 plus the 7%. Either way, we get a required return based on the CAPM of 13% for TempForce. Now, question P asks, what is the firm's current intrinsic value for the stock price? And they tell us that the company is a constant growth company, growing at 6% per year, with a dividend D0 of $2, and we want to know the intrinsic value. So to do this, we're going to use our constant growth dividend discount model, and that would be 2 times 1.06 divided by, and remember our required return is 13, so 2 times 1.06 divided by 13% minus 6% gives us an intrinsic value of $30.29. Now, in part 2, they ask us, what is the expected return 1 year from now? Well, we do exactly the same thing. So the only difference is we're shifting forward one period in time. So remember that dividend 1 would be $2 times 1.06, which is 212. But now we need dividend 2. So we're going to take the 212 times 1.06 and then divide that by 13% minus 6%. When we do that, we get $32.10. Now, in part 3, they ask, what are the expected dividend yield, the expected capital gains yield, and the expected total return during the first year? So let's talk about this for just a second. The expected dividend yield is simply next period's dividend, $2.12, divided by the current price, which is 30.29. That gives us about 7%. The capital gains yield is the change in price divided by the current price. So in 1 year, the price will be $32.10, and the current price is $30.29. So that's an increase of $1.81. That divided by 30.29 gives us a 6% capital gains yield. Remember, capital gains simply means change in price. Now, our total return is always going to be the sum of the capital gains yield and the dividend yield. So in this case, we have 6% plus 7% gives us 13%. Now, part Q says, assume that the stock is currently selling at $30.29, which is what we calculated. What is the expected rate of return? Well, I just went over that, so that's 13%. Now, part R says, assume that Tempforce's dividend is expected to experience non-constant growth of 30% from year 0 to year 1, 25% in the next year, 15% in the next year, and then after that it'll grow at 6% per year forever. Now notice, this is exactly what we've been doing previously with free cash flows. So we have non-constant growth followed by constant growth forever. So what do we need to do? Well, first step, we're going to find the horizon value at year 3. And then we're going to find the present value of the dividends from year 1, 2, and 3, plus the present value of the horizon value. That will give us the intrinsic value of the stock today. So the process is identical to what we've done with free cash flows. The only difference is now we're using dividends. And because we're using dividends, our discount rate is the required return on the common stock, not the weighted average cost of capital. Remember, the discount rate that you use depends on who has a claim on the cash flows that you're discounting. Only the stockholders have a claim on the dividends. So we use the stockholders' required rate of return, which we already know from the CAPM is 13%. So when we do that calculation, as you can see on the screen, we find that the intrinsic value of the stock at year 0 is 46.66. Now then, they ask what are the dividend yield and the capital gains yield during the first year. You can see the equation. We have a dividend yield of 5.57 and a capital gains yield of 7.43. Notice that they add up to 13%. And if you do that for year 2 or year 3, they will again add up to 13% exactly. That will always be the case. Remember, total return is the sum of the capital gains yield and the dividend yield. Now, finally, let's take a look at Part U. Part U switches gears just a little bit, and it asks us about the value of a preferred stock. Now, remember, preferred stock pays a constant dividend. It's never going to change. What that means is that the growth rate of that dividend is 0%. So if we use our dividend discount model, our constant growth model, because 0 is a constant growth rate, right? It's 0% every year from now to infinity. So we can use our constant growth model. We have 210 times 1 plus 0 divided by our required return minus the growth rate. Well, that's 7% minus 0. So what we end up with is simply the dividend divided by the required return. And in this case, that's 210 divided by 7%, 0.07, gives us a value of 30. Very simple. I hope that you found this discussion of the mini case to be helpful. If not, please go ahead and send me an email and let me know where you have any questions. And I will see you in the near future.